Welcome to Celebrity Investing, your go-to source for insights, tips and updates on navigating the exciting landscape of personal and global finance. Please like, share and subscribe for more exclusive content. This is part 1 of Unlock Steady Income, Investing in Bonds and Treasury Securities. Investing in fixed income securities such as bonds and Treasury securities can be a stable and rewarding addition to your investment portfolio. Fixed income securities are often favored for their reliable returns and lower risk compared to other investment options. Bonds and Treasury securities are popular choices within this category, each with its own unique characteristics and considerations. Bonds are debt securities issued by corporations or governments to raise capital. When you invest in a bond, you are essentially lending money to the issuer in exchange for periodic interest payments and the return of the principal amount at maturity. On the other hand, Treasury securities are issued by the U.S. Department of the Treasury and are considered among the safest investments in the market. Diversification is key in building a well-rounded investment portfolio, and adding fixed income securities can help balance out the overall risk. By spreading your investments across different asset classes, including stocks and bonds, you can reduce the impact of market volatility and potentially enhance your long-term financial stability. Investing in fixed income securities offers several benefits, such as steady income streams, capital preservation, and a hedge against market downturns. Whether you are a seasoned investor looking to diversify your portfolio or a beginner seeking stable returns, exploring the world of bonds and Treasury securities can provide valuable opportunities for financial growth and security. Understanding fixed income securities. Fixed income securities are financial instruments that provide investors with a predictable and steady income stream. These investments are known for their reliability and relatively lower risk compared to other types of investments. Understanding fixed income securities is crucial for diversifying a portfolio and balancing risk, definition and purpose. Fixed income securities represent loans made by investors to borrowers, such as governments or corporations, in exchange for periodic interest payments and the return of the initial investment at maturity. The primary purpose of fixed income securities is to generate income for investors while preserving capital. In uncertain economic times, these securities offer stability due to their predictable returns, making them attractive to a wide range of investors seeking a reliable source of income. Types of fixed income securities. Bonds. Bonds are one of the most common types of fixed income securities. When an investor purchases a bond, they are essentially lending money to the issuer, who agrees to pay back the principal amount at a specified maturity date, along with periodic interest payments. Treasury securities. Treasury securities are issued by the U.S. Department of the Treasury to finance the government's operations and manage the national debt. These securities are considered among the safest investments in the world due to the backing of the U.S. government. Municipal bonds. Municipal bonds are issued by state and local governments to fund public projects such as schools, highways and utilities. These bonds offer tax advantages to investors, making them popular for those in higher tax brackets. Corporate bonds. Corporate bonds are issued by companies to raise capital for various purposes, such as expansion or debt refinancing. The creditworthiness of the issuing company plays a significant role in determining the yield and risk associated with corporate bonds. Understanding the different types of fixed income securities allows investors to tailor their investment strategy to meet specific financial goals and risk tolerance levels. By diversifying across various types of fixed income securities, investors can build a resilient portfolio that withstands market fluctuations while generating a consistent income stream. Bonds vs. Treasury securities. Bonds have long been a go-to investment option for many individuals seeking a balance between risk and return. These fixed income securities represent a form of debt that an investor provides to an entity, typically a corporation or government, in exchange for regular interest payments over a specified period. Bonds function as a loan, where the issuer borrows funds from the bondholder and promises to repay the principal amount at maturity. The risk-return profile of bonds varies depending on factors such as the creditworthiness of the issuer, prevailing interest rates, and the bond's maturity. Bond prices fluctuate in response to changes in interest rates and economic conditions, making them sensitive to market dynamics. Bonds overview. Bonds are commonly issued by governments, municipalities, corporations, and other entities to raise capital. They offer investors a fixed interest rate, known as the coupon rate, which is paid periodically until the bond matures. The yield on a bond reflects the return an investor can expect based on the bond's price and interest payments. Bonds are categorized based on their issuer, maturity and credit quality, with varying levels of risk and return. Factors such as inflation, economic indicators and market sentiment influence bond prices, making them a versatile investment instrument for portfolio diversification. Treasury Securities overview. Treasury securities are debt obligations issued by the U.S. Department of the Treasury to finance government operations and manage the national debt. These securities are considered one of the safest investments available due to the backing of the U.S. government, making them a popular choice for risk-averse investors. Treasury securities come in three main types: Treasury bills, T-bills with short maturities, Treasury notes, T-notes with medium-term maturities, and Treasury bonds, T-bonds, with long-term maturities. They are known for their liquidity and minimal credit risk, serving as a benchmark for interest rates in the financial markets. Investors often turn to Treasury securities as a safe haven asset during periods of market volatility or economic uncertainty. Stay tuned for part 2 and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like and share to continue your journey to financial success.